Hi, I'm Jimmy. In this video, we're looking at the top 3 energy value stocks as we're heading into 2023. Then towards the end, we've actually got a bonus dividend stock that also seems to be trading at a decent value. But before we jump into that, let me tell you real quick about an investing platform we're building. So we've got our private investing community hosted over on Discord. On Discord, we got a whole bunch of different investing channels where we all talk, share ideas, do some research projects together, and ultimately try to get better as a community at investing. We also do a couple investing live streams, private investing live streams every week. We do a valuation live stream, we do a portfolio live stream where we talk about my portfolio, we build the different portfolios. Plus we do a research live stream where we try to analyze companies together and go through the process together so we could all get better at it. Okay, now let me tell you about the website that we're building. So we already built the beta version of our discounted cash flow calculator. And the idea is that we would have a website that has a bunch of different valuation methods. So it could be, how do you value banks? How do you value a large cap company? How do you value a real estate company? How do you value a company with no growth or negative free cash flow or negative profits? There's different ways to value all different types of companies. So that's where the website's trying to go. For now, we've already got the beta version of the DCF calculator up there. We're just going to keep adding from there. Now, if you'd like to sign up to get access to our investing community as well as the website, I will leave a link in the description below. Okay, now jumping over to our first value energy stock. So our first stock is ExxonMobil, ticker symbol XOM. ExxonMobil has a current price of about $110 per share, and it's currently valued at about $120 per share. Now, these were actually tricky to find. Value stocks in the energy sector have been tricky to find because the energy sector over the past year has performed extremely well, especially relative to a down stock market. So with a company like Exxon, which is, by the way, an integrated oil and gas company, which means that they operate in different parts of the oil and gas industry. We're going to touch more on this in a second. So on the bright side, we got a dividend yield of a bit over 3%. And on the semi-downside, or something to watch for at least, when we look at their free cash flow to revenue, their average free cash flow to revenue over the past 5 years, we can see it's right around 6%. But when we compare that to our next company, well, our next company does essentially the same thing, yet their free cash flow to revenue is over 9%. Now, Chevron, our next value energy stock, is one of the more operationally efficient energy stocks out there. This is one, I don't own any energy stocks right now, although I am looking to add something to my investment portfolio. But if I was going to, Chevron is one of the first ones I'm looking at because they are one of the premier companies out there. We can see that they are also classified as a oil and gas integrated, that's the sector that they fall in, but integrated oil and gas essentially means that they operate in multiple segments. So in the energy industry, there's upstream, midstream, and downstream. Upstream pulls the oil out of the ground, midstream ships the oil and gas, downstream refines it and sells it essentially. Gas stations, things like that would be considered a downstream business. Chevron and Exxon both have upstream and downstream businesses. But they also own a piece of the midstream business in, I believe it's their Noble Energy business. They acquired a piece of Noble Energy, which is a midstream company, again, does shipping, transportation, storage, things like that. Now, Chevron also has a dividend yield of a bit over 3%. We can see that clearly the fair value for this one looks to be much better off than the current price. So there's much higher upside compared to a company like Exxon. So out of the two, I like this one. But if we're looking for diversification, both might be worth considering. Okay, up next, we've got EQT, which is an exploration and production company. Now, although we're seeing that they're part of the oil and gas exploration and production industry, technically that's true, but this company really focuses on natural gas. But I think that one of the most important parts for us to consider when looking at this discounted cash flow calculation is look at the analyst estimates for free cash flow. First, we have the number of analysts that are projecting each year. By the way, these are analysts that usually at big investment banks, things like that. And we can see that the free cash flow numbers are gradually declining from year to year. That's a bit unusual. Most industries are going to see free cash flow climbing as long as the company's doing better than the year before. But the oil and gas industry is a little bit different because the price of oil and gas, a price per barrel of oil, a price per cubic foot of natural gas, those prices determine how much revenue a company can make. Well, broadly speaking, energy analysts are expecting for the price of oil and gas to decline over the coming years. So it's very possible that a company like EQT, which could be a very operationally efficient company and even, let's say, improving their operations, but if the price of oil and gas, in this case, natural gas, declines, by 30% over the next few years, free cash flow is going to decline. Interestingly, even with those declines in call it the incoming free cash flow or expected incoming free cash flow, the stock still looks super undervalued. Now, we're not getting as much of a dividend yield as we're typically been seeing with the other stocks. We've got a good dividend one coming up next. The dividend yield isn't as high, but the potential upside on the underlying stock seems to be quite good. So if it is dividends you're interested in, let's jump over to the next one, which is the HES Corporation, ticker symbol HESM. Now, we can see by looking quickly just at the fair value of this that compared to the current price, the stock looks super undervalued. Now, one quick criticism of this calculation is we can see we only have one analyst in the first year and the second year. By the way, when there's no analysts in the third year, the way we set up our valuation website is we've set it up to project off of historical numbers. So it takes revenue, it grows it out by another year, and then it takes free cash flow to revenue. What percentage is that? So the fact that there's no analyst in the third year is actually pulling down the fair value calculation because we can see the third year free cash flow numbers are actually lower than the second year. So if anything, it makes it a bit more conservative. Now, despite whether or not we believe that the stock should actually be worth $153 per share, the dividend yield on this one is what makes this one so interesting. The other thing that's interesting about this, because you may also notice that in the first 2 years, the analyst here is expecting an increase in free cash flow. The reason that we would have an increase here, but not an increase in a company like Chevron or Exxon, or even a company like the exploration and production companies that we've seen industry-wide, midstream companies are a little bit different. Don't forget, these guys are the guys that do the shipping and transportation for the industry, which means they care less about the underlying price of oil or gas. They're more of the toll operators of the energy industry. The more oil and gas that pass through, the better that this company will do. They essentially collect a fee for shipping oil and gas. In fact, if oil and gas prices fall, there's likely to be more oil and gas sold, so they will get an increase in free cash flow, hence a higher possible valuation. Now, it would take a deep dive to determine whether or not this stock is really worth $153 per share. By the way, if you want to see a deep dive on any of these stocks, please let me know in the comments below. But I do think that this is a great starting place. A nearly 7% dividend yield on an energy stock, even if the stock didn't move much, and we just collected our 7%, this could be a really interesting company to consider adding to our investment portfolio. Now, if you'd like to get access to the investing platform that we are building, as well as access to the live streams that we're doing, our private investing community, I will leave a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.